Ever wondered how businesses determine their selling price and profitability? Well, today we're going to explore one of the key methods they use, marginal costing. This technique, my friends, is all about variable costs, the costs that change as the level of output changes. Whether it's the cost of raw materials or direct labor, these are the costs that fluctuate with production volumes. In the realm of marginal costing, fixed costs like rent or salaries are treated as period costs and not production costs. This is a fundamental shift from traditional costing methods. But why, you might ask? Because it provides invaluable insights for management decisions. Whether it's pricing a new product, deciding to make or buy, or evaluating performance, marginal costing serves as a powerful tool. It's like a torchlight in the dark, helping businesses navigate the complex world of cost management. So, are you ready to dive in? Let's delve deeper into the world of marginal costing. Ever pondered upon the difference between absorption and variable costing? Well, let's unravel this puzzle together. Absorption costing, often known as full costing, is a method that takes into account all costs associated with production. This includes both variable costs, which change with the level of production, and fixed costs, which remain constant regardless of how much you produce. For instance, if you run a bakery, your variable costs might include the flour and sugar for each batch of cookies, while your fixed costs could be the rent for your storefront, which you have to pay whether you sell one cookie or 1,000. On the other hand, variable costing, sometimes called direct or marginal costing, only includes variable costs in the cost of goods sold. In this method, fixed costs are treated as period costs and are taken directly to the income statement as expenses of the period in which they are incurred. So, in our bakery example, under variable costing, the cost of cookies would only include the flour and sugar, not the rent. Now, how do these two methods impact income determination, you may ask? Well, that's where things get interesting. The key difference lies in how they treat fixed costs. Under absorption costing, fixed costs are spread among all units produced, decreasing the cost per unit as production increases. Therefore, when more units are produced than sold, absorption costing will show a higher net income than variable costing. In contrast, under variable costing, fixed costs are not spread among units produced. Therefore, the net income under variable costing will be higher when fewer units are produced than sold. The choice between these two methods can significantly affect a company's reported profits and ultimately its financial health. Understanding these two methods and their impacts on income determination is crucial for making informed decisions that can steer your business in the right direction. So don't underestimate the power of a good costing method. Now you're familiar with the differences between absorption and variable costing. Up next, let's dive deeper into the world of marginal costing and explore concepts like the profit-volume ratio and break-even analysis. Stay tuned. How do companies analyze profitability and the break-even point? Well, it all starts with understanding the profit-volume ratio. This ratio is a measure of a company's profitability. Simply put, it's the relationship between the profit of a firm and its sales volume. The higher the ratio, the more profitable each unit of sale is for the company. This ratio is a crucial tool for managers as it helps them understand how changes in sales volume impact the company's bottom line. Now let's delve into the concept of break-even analysis. This is a technique used by businesses to determine the point at which they will start making a profit. It's the point where total revenue equals total costs. Before this point, the company is in a loss-making state. After this point, each additional unit sold contributes to profit. The break-even point can be calculated in two ways: algebraically and graphically. The algebraic method involves some simple mathematics. It's all about subtracting the variable cost per unit from the selling price per unit, and then dividing the fixed cost by this difference. The result is the number of units that need to be sold to cover all costs. On the other hand, the graphical method involves plotting the total cost and total revenue on a graph. The point where these two lines intersect is the break-even point. Both methods offer valuable insights, but the graphical method provides a more visual representation, which can be easier to understand and communicate to others. Remember, understanding the profit-volume ratio and the break-even point is not just an academic exercise. These are practical tools that can help businesses make informed decisions. They can guide pricing strategies, influence production levels, and even shape the company's overall business model. With these tools, businesses can make informed decisions. What are the angle of incidence, margin of safety, and key factor in marginal costing? Let's start by decoding these terms. The angle of incidence is a fascinating concept in the realm of marginal costing. Picture a break-even chart in your mind. The point where the sales line intersects the total cost line, the angle formed there is what we call the angle of incidence. The larger this angle, the greater the profitability of the business. It's like a visual representation of the business's earning capacity. Simple, isn't it? Moving forward, let's talk about margin of safety. Now, this is not about the safe distance you maintain from a cliff edge, but it's just as crucial in the business world. Margin of safety is the difference between your actual or budgeted sales and the break-even sales. To put it simply, it's the buffer you have before you start incurring losses. The larger your margin of safety, the more protected you are from a drop in sales. It's like your safety net in the acrobatics of business. Finally, we come to the key factor. This is not a secret code, but it's equally important. The key factor is that limiting factor which restricts your business from achieving a higher level of operational activity. It could be anything: a shortage of raw materials, lack of skilled labor, or even market demand. Identifying and managing this key factor is crucial for optimizing your business operations and maximizing profitability. Remember, every business is a complex interplay of numerous factors, and understanding these terms, angle of incidence, margin of safety, and key factor, can give you a clearer perspective. They are like the compass, safety gear, and map in your business expedition, guiding you towards profitability and sustainability. These terms are crucial in understanding the nuances of marginal costing. How does a company determine the cost indifference point, and what are the marginal costing techniques? Let's delve into these concepts and untangle the threads of cost accounting. The cost indifference point is a critical concept in managerial accounting. It's that particular level of activity where the total costs under both marginal and absorption costing are the same. Imagine two roads diverging in a yellow wood, and at one point they intersect. That point of intersection is akin to the cost indifference point. It's where the total costs under both the marginal and absorption costing methods meet. But how do we calculate it? The most common formula is to subtract the variable cost per unit under absorption costing from the variable cost per unit under marginal costing. Then divide the fixed cost difference by the result. This gives us the cost indifference point, which is the production level where both costing methods result in the same total cost. Now let's shift gears and talk about marginal costing techniques. These are tools that businesses use to analyze cost behavior and make informed decisions. The contribution margin ratio, for instance, can help a company understand how changes in sales volumes could impact its profits. It's calculated by dividing the contribution margin by total sales. A higher ratio indicates a more profitable product or service. Another technique is the variable costing ratio, which measures the proportion of variable costs to sales. It's calculated by dividing variable costs by total sales. This ratio helps in identifying how changes in sales volumes can affect costs. These are just a couple of examples among a suite of marginal costing techniques. Each technique serves as a lens through which a company can view its cost behavior and profitability. By mastering these techniques, a business can optimize its operations, maximize its profits, and make sound strategic decisions. So, to answer our initial question, how does a company determine the cost indifference point, and what are the marginal costing techniques? The answer lies in understanding these concepts and how they interact. These techniques help in making crucial business decisions. So next time you're on the road of business decision-making, remember, numbers are your compass and these techniques your map. Now, aren't you amazed by how marginal costing influences business decisions? We've journeyed through the vital concept of marginal costing, a cog in the wheel of financial management. We've demystified the dichotomy between absorption and variable costing, revealing their unique features and impact on income determination. We've delved into the significance of the profit-volume ratio, how it's a beacon guiding businesses towards profitable ventures. We've dissected the break-even analysis. Both algebraic and graphic methods, a critical tool for businesses to navigate through uncertain economic waters. We've shed light on the angle of incidence, margin of safety, and the key factor, all essential elements in the realm of cost accounting. We've also explored the determination of cost indifference point, a crucial juncture in decision-making, and of course we've sifted through the nuances of marginal costing techniques, the backbone of effective cost control. With this knowledge, you're one step closer to understanding the financial workings of a business.